Welcome to the Smart Money Playbook. This video explores the inner circle trader concepts, covering market structure, liquidity, order blocks, fair value gaps, time and price, and entry models. This is an educational overview and not financial advice. What is ICT? It is a framework for reading price through the lens of liquidity and institutional order flow. Instead of relying on lagging indicators, ICT views the chart as a map of where large players need to fill orders, focusing on where liquidity rests. The core premise of ICT is simple. Liquidity is the primary target as markets move to where orders rest. Smart money leaves footprints through order blocks and gaps, and price is delivered in repeatable patterns, not randomly. Remember that ICT is just one lens. At Hollow Point Trading, we use a three-pillar framework. Always backtest these concepts and use them to refine your own strategy. No single model is a holy grail. Here is our roadmap. We will progress through market structure, liquidity, order blocks, fair value gaps, time and price, and finally, entry models and risk management. Module 1 focuses on market structure, helping you identify trends and understand when they shift. Market structure is defined by the sequence of swing highs and lows. Recognizing whether the market is in an uptrend, a downtrend, or a range allows you to understand how price is being delivered. Swing highs and lows are the building blocks of market structure. A swing high is a peak between lower highs, and a swing low is a trough between higher lows. Connecting these points reveals the trend. In an uptrend, price creates higher highs and higher lows. As long as this sequence remains intact, the trend is considered healthy and reliable for trading. Conversely, a downtrend mirrors this by creating lower highs and lower lows. Respecting this structure is essential, as trading against the current can be dangerous. A break of structure, or BOS, confirms the continuation of a trend. A bullish BOS occurs when price breaks a prior swing high, while a bearish BOS occurs when price breaks a prior swing low. A change of character, or choke, is your earliest warning that a trend might be reversing. This happens when price breaks structure against the prevailing direction. It is important to distinguish between external and internal structure. External structure represents the major swing points on your higher time frame, while internal structure refers to the micro moves within those larger legs. Understanding premium and discount is key to avoiding chasing price. By splitting a dealing range at its 50% equilibrium, you can identify where it is institutional to buy or sell. A dealing range is defined by the span between a clear swing high and swing low. It provides the framework for identifying liquidity and determining if price is in a premium or discount zone. A market structure shift, or MSS, is a decisive break in structure that often happens through a fair value gap. It flips the order flow and serves as the primary confirmation that ICT entries wait for before committing to a trade. To summarize market structure, it is the sequence of swing highs and lows defining the trend. Remember, BOS confirms continuation, while choke warns of a reversal. Always use equilibrium to find discount for buying or premium for selling. Welcome to Module 2, Liquidity. In this section, we will cover exactly where institutional orders rest and how they influence price delivery. Liquidity is the pool of resting stop losses and pending orders that large players require to fill their massive positions. Price is drawn to these areas like water to low ground, using them as fuel to continue a reverse. We categorize liquidity into two main types: buy side and sell side. Buy side liquidity consists of resting buy orders above old highs, while sell side liquidity holds resting sell orders below old lows. Liquidity pools concentrate where many traders make the same mistakes. ICT identifies these as obvious clusters, including old swing points, equal highs and lows, session extremes, and clearly visible trend lines. Equal highs and equal lows are particularly effective magnets for price. When traders see price bounce off the same level multiple times, they stack their stop orders there, making those levels prime targets for liquidity collection. A liquidity raid, or stop hunt, occurs when price sharply wicks beyond an obvious level to trigger stop orders before immediately snapping back. Don't mistake this for a breakout. It is often the market fueling a reversal. Be wary of obvious trend lines. The easier a trend line is to draw, the more retail traders are trailing their stops along it. This makes it an incredibly vulnerable target for institutional price action to sweep. Inducement is a classic trap. It involves placing a minor high or low just before a true point of interest, baiting traders to enter early. These traders become the liquidity that fuels the institutional move to the real target. A liquidity void is a gap created by a fast, one-sided price move. Because markets aim for efficiency, they will often return to rebalance these areas, filling the void before continuing in the original direction. The turtle soup pattern is a reliable reversal indicator. It involves three steps. Price sweeps an old high or low, fails to maintain momentum beyond it, and reverses back inside the range, trapping those who chase the move. To recap liquidity, it is the fuel for large players. Focus on buy and sell side pools, avoid chasing breakout raids on trend lines, and watch for how institutions use inducement to trap retail traders. Moving to Module 3, Order Blocks. Here, we analyze the institutional footprints that define where the big money enters the market. An order block is the final opposing candle before a strong, structure-breaking move. These zones represent where institutions loaded their positions, making them high-probability areas for a reaction when price returns to them. A bullish order block is the last down candle before a strong rally that breaks structure to the upside. When price returns to this zone, it often acts as support, making it an ideal area to look for long opportunities. A bearish order block is the last up candle before a strong sell-off that breaks structure to the downside. These zones are significant because when price returns to them, they often act as resistance, providing an area to look for short positions. To identify an order block, follow these steps. First, find a strong move that breaks market structure. Second, mark the last opposing candle. Third, box the zone from the candle's open or close to its high or low. Finally, look for confluence, such as a liquidity sweep. A mitigation block forms when price returns to an old order block to mitigate trap traders, allowing them to exit near break-even before the market resumes its trend. It is essentially an order block that has been revisited and respected. A breaker block is an order block that failed, meaning price broke through it. This event causes the level to flip polarity. A broken bullish order block becomes resistance, while a broken bearish order block flips to support. Rejection blocks focus on wicks. A cluster of long wicks rejecting a price level indicates where price was aggressively refused. Traders use these wick zones as reference points for future reactions, essentially trading the wicks instead of the bodies. A propulsion block is an order block that price respects and uses to launch with momentum. It stacks on top of an existing order block to propel the next leg of the move, essentially acting as an order block on steroids. For the highest probability trades, look for order block confluence. When an order block overlaps a fair value gap and sits below swept liquidity, you have an A+ ICT entry zone, combining multiple elements of institutional footprinting. In summary, order blocks represent institutional entries. Remember the different types: mitigation, breaker, rejection, and propulsion blocks. Always aim for A+ setups by looking for confluence with fair value gaps and liquidity sweeps. Welcome to Module 4, where we cover fair value gaps or FVGs. Understanding imbalance and rebalancing is critical for mastering ICT price delivery. Imbalance is essentially market inefficiency. It occurs when price moves so fast that one side barely trades. Because the market seeks efficiency, it frequently returns to these zones to rebalance, providing opportunities for traders. A fair value gap is a specific three-candle pattern. The gap is the space between the first candle's high and the third candle's low in a bullish trend, where the middle candle ran without overlap. It serves as our return zone. A bullish FVG forms during an upward move. It represents a potential buy zone, where price often dips back into the gap to rebalance before continuing its ascent. Conversely, a bearish FVG occurs during a downward move. This is the gap between the first candle's low and the third candle's high. Price often rallies back into this zone, making it a prime area to look for shorts. To identify an FVG, find a three-candle impulse. Ensure the wicks of the first and third candles do not overlap. Mark the resulting space between them as your FVG, and watch for price to return and fill the imbalance. When price trades fully through a fair value gap instead of respecting it, the gap inverts. A bullish FVG that fails turns into resistance, while a bearish FVG that fails flips to become support. Once price trades back through an FVG, the inefficiency is rebalanced, meaning the gap has served its purpose. A zone where FVGs are filled on both sides creates a balanced price range with no remaining draw. Remember, an unfilled gap acts like a magnet, but a filled gap is spent. How do you use an FVG? For entries, wait for price to return to the gap, enter as it rebalances, and place your stop beyond the far edge. As a target, an unfilled gap acts as a magnet for taking profits, especially on higher timeframes. To summarize, an FVG is a three-candle imbalance with no overlap. Bullish gaps become buy zones, and bearish ones become sell zones when filled. Remember, failed gaps invert, and always distinguish between unfilled magnetic gaps and spent filled ones. Welcome to Module 05. In this section of the video, we explore the critical relationship between time and price, focusing on trading sessions and the daily market cycle. In ICT trading, time is just as important as price. A setup often carries more weight during specific high-probability windows and might be ignored entirely outside of them. We aim to hunt setups during these active periods and stand aside during low liquidity hours. Kill zones are high-probability windows for major market moves. These include the Asian range, the London session for the first major move, the NYAM session as the prime window, and the NYPM session for potential afternoon continuation. The London kill zone, typically between 2 and 5 a.m. Eastern, often sets the initial directional move for the day. It frequently sweeps liquidity from the Asian range before revealing the market's true intent. The New York AM session from 8:30 to 11 a.m. Eastern is considered the prime time for many ICT models. This window often sees news, volume, and the cleanest price reversals, making it a favorite for many traders. The overnight Asian session is generally quiet and range-bound. This tight consolidation builds liquidity above and below the range, creating pools that the London and New York sessions look to raid. A Judah swing is a deceptive move that fakes out traders before reversing into the true direction. Often appearing at the start of a session, it serves to grab liquidity before the real move begins. The Power of Three, or AMD, describes the three phases of the daily candle: accumulation, manipulation, and distribution. Understanding this cycle helps you spot the false move and catch the expansion. The Silver Bullet is a simple, time-based model focusing on a specific 1-hour window to hunt for a clean FVG entry. The classic windows for this are 10 to 11 a.m. and 2 to 3 p.m. Eastern. ICT macros are short, recurring windows that often align with the top or bottom of the hour. They represent periods where algorithmic activity is designed to drive price toward liquidity or rebalance gaps. Finally, your daily bias is your directional thesis, built using a top-down approach. Always ask, where is the liquidity? What is the higher time frame draw? And what is your resulting bias for the day? This video covers the key takeaways regarding time and price. Remember that your setup strength is relative to the kill zone, liquidity is built in Asia and rated in London or New York, and always define your daily bias before hunting for entries. We are now moving into Module 06, Entry Models. Here, we transition from observing concepts to applying them into actionable trading setups. ICT organizes trading tools into premium and discount, or PD arrays. Above equilibrium, you favor premium arrays to sell. Below it, you favor discount arrays to buy. This helps you identify where price is likely to react. The Optimal Trade Entry, or OTE, uses Fibonacci levels to time entries during a retracement. After an impulse leg, look for the 62 to 79% pullback zone. This provides a balance between risk and reward and the probability of catching the trend. Within your Fibonacci tool, ICT settings focus on specific levels: 0.62 for the shallow edge, 0.79 for the deep edge, and the 0.705 level as the sweet spot for the trade entry. Most ICT setups follow a core flow. First, identify a liquidity sweep. Second, look for a market structure shift. Third, wait for price to return to an order block, or FVG. Finally, execute your entry on confirmation. The unicorn model is defined by high confluence zones. It occurs when a breaker block overlaps with a fair value gap, creating a precise area for entry. The Silver Bullet setup is highly dependent on timing. Wait for the designated windows of 10 to 11 a.m. or 2 to 3 p.m. Eastern. Mark recent liquidity. Identify the FVG left behind, and enter on the fill. The 2022 model is a structured approach. Raid liquidity. Look for displacement that creates an FVG, enter on the return to that gap, and target the opposite liquidity pool. The Turtle Soup model focuses on reversing false breakouts. When price sweeps a significant high or low but fails to follow through, you enter on the snapback to fade the trap traders. After a structure shift, you can project targets using standard deviations of the impulse leg. -1 to 2 standard deviations are initial targets, while -2.5 to 4 serve as extended objectives. To summarize our entry models, use PD arrays to define zones, OTE for timing, and the core flow of liquidity sweeps and structure shifts. Remember that models like the Unicorn or 2022 are just variations of this cycle. We now begin Module 07, Risk and Execution. This module focuses on the discipline required to translate your analysis into consistent execution. Proper stop placement is critical. Always place your stop beyond the level that invalidates your trade idea, past the swept liquidity, or the far edge of the OB or FVG used for entry. If price breaches that level, your thesis is simply incorrect. When it comes to exits, target the next obvious pool of liquidity. Use old highs, old lows, equal levels, or unfilled higher timeframe gaps to guide your profit taking. The draw on liquidity should always define your exit. Welcome to the module on risk and execution. Because ICT entries are typically placed at the edge of a zone with tight invalidation, they are built for asymmetry. You should demand a minimum of 2 to on risk to reward, though many high-quality setups will offer 3 to 1, 5 to 1, or even better. No single concept is enough on its own. The best trades line up several confluences at once. The more boxes you can check, the higher the probability of the trade, which also makes it significantly easier to hold your position through market noise. Always work with a top-down approach. You must establish your direction and identify key levels on the higher timeframe before dropping down to a lower timeframe for your execution. A lower timeframe entry taken against the higher timeframe draw on liquidity is typically a low probability trade. Concepts only become a genuine edge once you have proven them on your specific market and time frame. Backtest a single model consistently until the pattern recognition becomes automatic, and journal every live trade to refine your approach. Avoid these common mistakes. Do not force setups by seeing order blocks or gaps on every candle. Do not trade against your higher time frame bias, ignore the time, chase liquidity sweeps without a structure shift, or hoard models instead of mastering one. To recap your execution process, place stops beyond your invalidation point, trade liquidity to liquidity, and always demand asymmetry in your risk-to-reward ratio. Work top-down and ensure you have thoroughly backtested your specific model before trusting it with live capital. Here is a quick reference for the ICT glossary. BOS refers to a break of structure, signaling trend continuation. Choate stands for change of character, representing the first sign of a reversal. Continuing the glossary. OTE is your optimal trade entry, usually a 62 to 79% retracement. PD array refers to your menu of premium and discount levels. A kill zone is a specific, high-probability session window where the most significant market activity typically occurs. In this walkthrough, we look at the setup. First, verify your higher timeframe bias. Second, look for a liquidity sweep. Third, confirm a market structure shift that shows the trend has officially turned, leaving an imbalance behind. For the entry, wait for price to return to your chosen order block or fair value gap. Place your stop just below the invalidation point and set your target at the next liquidity pool, aiming for at least a 2-to-1 reward. This slide provides a comprehensive cheat sheet for the core concepts we have covered, summarizing the essential components of the ICT framework for your quick review. ICT is a powerful technical lens, but it is just one pillar of the hollow point trading framework. Your technical analysis must always be balanced by an understanding of the broader macro environment and the fundamental drivers of the asset. Use this pre-trade checklist. Is your bias aligned? Has liquidity been swept? Did structure shift? Are you entering from a premium or discount array? Is there an order block or gap to trade from? Does the setup offer sufficient risk to reward? To summarize the process, read the structure and bias, locate your liquidity and draw, wait for the sweep and shift, then enter at the order block or gap. Liquidity is the why, structure is the when, and zones are the where. Read the liquidity and respect the structure. Thank you for following along with this overview of the Smart Money Playbook. For more educational resources, you can find us on YouTube, Discord, and our Substack.